Most traders watching this video already know about candlestick patterns, and they even take trades based on them. But the problem is, their entries fail most of the time. For example, look at this chart on xauusd. After moving inside a range, price breaks below the range and forms what looks like a clean, bearish engulfing pattern. Retail traders instantly jump into a sell trade, but within a few candles, price reverses sharply, and they get trapped. This happens again and again. Traders trust candlestick patterns blindly, but still fail to make profits consistently. So in today's video, we're going to learn how to identify candlestick patterns properly and how to take entries at the right location with actual market logic. Candles tell you 4 important values. A single candle gives you 4 key price points: where the candle opened, the high it created, the low it created, and where the candle closed. The size and behavior of every candle completely depends on these 4 values. If a candle closes above its opening price, buyers are in control. If it closes below its opening price, sellers dominate that candle. For example, this 5-minute bullish candle on xauusd closed above its open. This shows buyers controlled the market during that 5-minute period. The next candle opens lower but still closes higher, again showing buyer strength. But the candle after that opens strongly at a higher price and closes deep to the downside. This means sellers overcame buyers in those last few minutes. But does this mean sellers have fully taken control? If you only look at the last 5-minute candle, you might think sellers are stronger now. But the truth is, you cannot judge the entire market by one candle. If you combine these 3 candles and look at them as a 15-minute candle, you'll notice something interesting. Price opened at a certain level and closed almost at the same level, meaning neither buyers nor sellers actually dominated. It was simply a neutral candle. This is where most traders misinterpret candlesticks. A real example: on xauusd, price consolidates for a while and then breaks below the consolidation. On the chart, you might see a bearish pattern at the breakdown, and many traders instantly enter a short trade. But this is a major mistake, because when price breaks a support zone for the very first time and then immediately pulls back, that low becomes a fresh swing low. This means there are still buyers sitting in this zone who do not want the market to drop any further. So if price must truly continue downward, we need a strong candle closing below this newly created swing low. But the breakdown candle actually closes inside the zone, not below it. This means sellers failed to take control. The next candle pushes upward instead of downward, and soon price closes above the rejection level that originally pushed price down. This shows sellers are completely exhausted and the market is preparing to move upward. Price sweeps liquidity below and then targets the higher level liquidity sitting above. Always remember, whenever liquidity at one side is cleared, the market naturally moves toward the next liquidity pool. If this understanding shocked you, many traders have no idea how candlestick patterns really work when combined with liquidity and structure. But now you know the truth. Let's return to our chart study. The 3 candles you will see most often in bullish or bearish trends. In trending markets, you will frequently see these 3 major candle types. One of them is what we call the big bullish or big bearish momentum candle, a candle formed when either buyers or sellers take complete control, pushing price strongly in one direction. When volatility spikes and momentum increases, these big candles appear more often. But here's the truth: most of these momentum candles exist only to trap retail traders. Let's understand this with an example on xauusd. Example: how big momentum candles trap traders' price consolidates for some time. Then suddenly, a large bullish momentum candle appears. Retail traders immediately think, "This is a breakout. price will explode upward, so they enter a long trade. But within minutes, price reverses sharply downward and hits their stop loss. They take a loss on their first trade. Price continues falling for a bit, then suddenly creates another big bullish candle. Retail traders think again. This time, it will reverse for sure. They enter another long trade. But once again, price drops sharply, hits their stop loss, and they take their second loss. By now, they are frustrated. They decide, I won't take any more trades until the consolidation zone breaks properly. And after some time, the market does exactly that. A huge bullish candle breaks out of the range. This is the third momentum candle. Thinking this breakout is real, they enter a long trade again. And once again, price instantly reverses and takes out their stop loss. Now, within one session, they have been trapped 3 times by the same type of candle. Why does this happen? Because large institutions use these momentum candles to create panic, trigger emotional reactions. They use the candle as a weapon, a psychological trap. Retail traders look at just the candle, but institutions look at liquidity. And when liquidity sits above or below a range, smart money will always push price toward it. That's why whenever you see candles that are unusually large compared to normal price action, you must stay cautious. These momentum candles will give you profits maybe 1 time out of 10, and if you don't believe it, open any chart, backtest it yourself, you'll see the truth. Now let's understand the next candle type, reversal candles, long wick rejection candles. Many traders call them hammer candles, pin bars, or inverted candles. These candles have very large wicks compared to their body, showing a strong rejection from a level. Here's an example on xauusd. Price rejects from higher levels and approaches a psychological area, and forms multiple long lower wick candles. In these candles, price opens at a level, moves sharply downward, but faces strong buying pressure and closes back near its opening price. This tells us sellers pushed price down first, but they failed to close below the low. Buyers stepped in aggressively. Buyers are now interested in taking price higher. If you look closely, buyers attempted to push price upward multiple times. Candle sizes are getting smaller on the way down, showing sellers are losing strength. So how do we trade it? If price closes above the high of the rejection candle, we can plan a reversal entry. And once buyers overpower sellers, price often moves strongly in the opposite direction. In bearish reversals, the exact opposite happens. Price rejects from upper levels and forms long upper wick candles. Whenever you see long lower wicks near support, long upper wicks near resistance, it indicates reversal probability is high. But remember, do not enter the reversal trade until price breaks the range. After entering, stay in the trade until a candle closes outside the rejection zone. This rejection zone acts like a protective barrier for your stop loss. So keeping a strict stop loss is important. Indecision candles, market confusion candles. These candles appear when buyers and sellers are uncertain about direction. In such candles, price opens at a level, moves both sides, and closes near the opening level. This creates long wicks on both ends with almost no real body. It means buyers are not in control. Sellers are not in control. The market is in pure uncertainty. Indecision candles usually form when a strong bullish-bearish move is ending. Price starts consolidating. At the end of strong trends, you will often see a cluster of indecision candles. Now here's something important. If you see a long lower wick candle immediately followed by a long upper wick candle in the opposite direction, this combination also acts like an indecision zone. Why? Because first, buyers push price up and get rejected. Then sellers push price down and get rejected. If you mark the highs and lows of both these candles, you'll notice it forms a clear indecision range. Indecision candles don't give entries. They only tell you one thing clearly: wait for breakout, don't jump early, and until price breaks out of this entire zone, and gives a proper close either above or below it. You should avoid taking trades in any direction. Because the rule is very simple, if there is no breakout, there is no trade. Now, when you look at any chart, your first focus should always be on reading momentum through candle size and candle structure. For example, as price moves downward through these levels, you can clearly see strong, large bearish candles. This shows heavy selling pressure. But later, momentum starts weakening. Candles become smaller, and long wicks begin to appear on both sides. This tells you sellers are losing strength. Fresh selling positions are not being added. Momentum is slowing down. Whenever this happens, the probability of the trend continuing sharply becomes very low. Instead, the market needs time to consolidate, build liquidity, and attract new participants before it can continue in the same direction. Smart money uses this exact moment to trap retail traders again and again. That's why you must not only look at candlestick patterns, you must understand the psychology behind them. Only then will your entries become accurate and your stop losses protected.